What's up, future CPAs of the Philippines? If you're deep in your review for management advisory services, you know the cost of capital can be a total beast. But hey, don't sweat it. In the next few minutes, we're going to break down the weighted average cost of capital, WACC, so you can absolutely own this topic on the LECPA. Let's get into it. Okay, just imagine this for a sec. You're the chief financial officer. The CEO walks in and drops a proposal for a massive new factory on your desk. This isn't just some problem in a textbook, right? This is a multi-million peso decision. The company's future and maybe even your career is riding on your analysis. So how do you make the right call? What's your go-to tool?
You use WACC, that's your answer. Honestly, the easiest way to think about WACC is that it's the company's minimum passing grade for any new project. It's the blended average cost of all the money the company uses, from shareholders, from banks, you name it. If that new factory project can't earn a return higher than your WACC, it's a fail. It's a no-go. It's that simple, but also that powerful.
Okay, so how in the world do we calculate this super important number? Let's take a look at the formula. And I know, I get it, formulas can look pretty intimidating, staring back at you from an exam paper. But trust me, we're about to break this down into really simple, easy-to-remember parts. So this is the whole shebang. At its heart, the WACC formula is just adding up a few things. We're taking the cost of each slice of the company's funding pie, and we're weighting it based on how big that slice is. See? There's a piece for equity, a piece for debt, and a piece for preferred stock. Let's look at them one by one. First up, we've got common equity. This piece of the puzzle is all about what the owners, the common shareholders, expect to earn for putting their money into the company. All you do is take its weight, which is just its proportion of the total funding, and multiply it by its cost. Pretty straightforward, right? All right, next up is debt. Just like with equity, we take the weight of debt and multiply by the cost of debt. But, and you gotta pay attention here, look at that last part, 1 minus the tax rate. Why is that there? Well, it's because the government gives companies a break. The interest they pay on debt is tax deductible. It's a tax shield. And seriously, forgetting this little piece is one of the biggest mistakes people make on the exam. So please, burn this into your brain. And finally, there's a spot for preferred stock, if the company even has any. It's just like the others, weight times cost. But notice, there's no tax adjustment here. That's because preferred dividends are paid with after-tax money. So if the exam problem doesn't say anything about preferred stock, you just ignore this part completely. Easy. So what about those W's, the weights? Where do they come from? The absolute key, and I can't stress this enough, is to use market value. So, step 1, figure out the current market value of the company's stock, its debt, and its preferred stock. Step 2, add all of that up to get the total value of the company. Step 3, just divide each piece by the total to get its percentage. Getting these weights right is the foundation. If you mess this up, the whole calculation is toast. Okay, listen up, because this next part, this is everything. This is the one concept that separates the people who pass from everyone else on this topic. You absolutely must use market values, not book values. Let's dive into exactly why this is such a make or break deal. The difference here is super critical. Book value, that's a history lesson. It's what the company paid for stuff way back when. It's the old price on the receipt. Market value, that's reality. It's what that capital is worth right now, today. And since WACC is all about making decisions for the future, we have to use today's values. Using book value is like trying to drive a car forward while only looking in the rearview mirror. It's just not going to end well. I love this quote because it just nails it. Market value shows the current economic sacrifice. Think about what that means. It's what it would actually cost you to get your hands on that capital right now. That's what matters for new decisions. And I promise you, the exam creators love to throw book value numbers into the problem just to see if you'll fall for the trap. Don't fall for it. Okay, so you've done all the math. You've got your WACC number. Now what? What's the point? Well, this number now becomes your magic benchmark for making decisions. We call it the hurdle rate. Think of it like a high jump. Any project the company is thinking about has to clear this bar, this hurdle, that's set by the WACC. When you're calculating net present value, or NPV, WACC is the discount rate you use. If you end up with a positive NPV, congrats, your project cleared the hurdle. And when you're looking at internal rate of return, or IRR, it's even more direct. If the project's IRR is higher than the WACC, you accept it. If not, you walk away. In both cases, WACC is the ultimate test to see if a project actually creates value. Okay, one last little detail, and this is for those tricky next-level questions. It's WACC versus MCC. So WACC is the average cost of all the capital the company currently has. The marginal cost of capital, or MCC, is the cost of raising the very next peso for new projects. When you're making decisions about the future, it's really the MCC that's the most accurate hurdle rate because it reflects the cost of the new money you're about to spend. All right, time to switch gears. Let's get straight into the high-yield info, the stuff you absolutely need to lock in for exam day. Think of this as your rapid-fire cheat sheet for maximum retention. These right here are the non-negotiables, the 5 commandments of WACC. Number 1, market, value, weights, always. Number 2, for the cost of debt, use its current yield, the YTM, not some old coupon rate from years ago. 3, that tax shield, it is only for debt. Don't you dare apply it anywhere else. 4, WACC is about the future, not the past. We are looking through the windshield. And 5, a project's return must beat the WACC. It has to be greater. If you master these 5 rules, you've mastered WACC. Now for some hacks to help you work smarter. First, pro tip, if the problem gives you target weights for the capital structure, that's a gift. Use them. It's a hint about where the company is headed. Second, when you see a super long story problem, don't panic, just be a detective. Hunt for the 3 things you need: weights, costs, and the tax rate. Ignore all the other noise. Third, a dumb but effective mnemonic. A project's return has to walk the hurdle rate to get approved. Cheesy, I know, but it works. And finally, the number 1 hack is to just practice. Get those RISA review materials and grind out the problems until it's pure muscle memory. So there you have it. WACC isn't just some random formula you memorize for an exam. It is a fundamental tool that real business leaders use to build successful companies. You're not just learning this stuff to pass the LECPA, you're learning the actual language of value creation. So the real question is, once you've mastered this knowledge, what value will you create? Good luck, future CPAs. You've got this.